Hey everyone, Nick Shaheen here looking at the yield curve. And this is where we're going to have beef. Who's we? Me and Wall Street. I said something today on Twitter, or this week, recently on Twitter, and somebody, seems like a nice guy, took issue with what I said. My beef was with CNBC, how they play on words with the yield curve. Yield curve this, yield curve that. Right here, last year in August, they scared the bejesus out of markets because the yield curve had inverted. Okay, so what I'm showing is a mathematical representation of an inversion. It's a division. It's not a spread. So this is where they play on words and where Wall Street hides behind the spread this, NIM that, and all bullshit. Okay, so the yield curve in concept tells a bad story for the economy for a very simple fact. Banks borrow short-term, they lend long-term. If the short-term is too costly for them, more expensive than the long-term rate that they can get from us, then they won't borrow. So the economy stalls. That's why they say the yield curve inversion, meaning the short-term rates, the 2-year yield is bigger than the 10-year yield. That's a problem for the economy. I agree. That happened here. Okay? This is where we are right now. Per this division, not the yield spread, and I'll show you what the yield spread, and I'll try to walk through the logic why I would look at a ratio versus a spread. If you're telling me the inversion of the yield, first of all, the yield curve, what the hell is it? Okay, so it's a bunch, okay, I put it in Excel. Okay, so this is the yield curve currently, today. I pulled it off the federal website. Okay, this is the 1 month, 2 month, 3 month, and they should be low and gradually rising. So a 10-year yield should pay you more than a 2-year yield, correct? So that makes sense, a yield curve inversion. So if you chart that, it would look like this. Nice yield curve, whoops. Ascending yield curve, whatever this thing is. It tells me there's a good thing going on. If I invert it, I merely took the reverse of this order, just the 127 is on the left. So if this is true, then this is an inverted yield. It should be going lower left to the upper right, and it doesn't. That's inverted. It's going down. So this is the yield curve per each payout. So the 2-year pays out 23 cents percent, 0.23, and this one is 0.6, the 10-year, 0.6. This means that the longer term is higher than the shorter term, and this is what my chart represents. This was the inversion, the point in time where the ratio between the 10s and the 2s became less than 1. So if you have one number divided by another number, and that ratio is less than 1, that means the denominator is bigger than the top, correct? So that means the 2-year is bigger than the 10-year. That's the visual representation of an inversion of the yield curve. So Mr. Wall Street, instead of nitpicking the bull crap out of my statement, go with the flow and use logic. If banks borrow short-term, lend long-term, this is fine. In fact, this is the yield curve from the Fed. I forget the website. Anyway, some website out there that has historicals on it. So this is the actual minus that this other guy had a conniption on. 10-year minus a 2-year. Okay, so if I go to a 5-year, it's still, this is the 5-year. So I can't make a decision as to what point in time actually the inversion happened. I'm not that smart. And I know that it happened here somewhere in this stretch in August of 2019. So this is where we are right now. Clearly, when Dom Chu is talking like, hey, remember back in August? Yeah, we still need that to revert. What the fuck are you talking about? This is where we are right now. This is where it was in August. So flip that. I'm going to go to max. Okay, so this is where we are right now. Guess what this is? The exit out of the financial debacle. Guess what this is? The exit out of the 2000 debacle. Guess what this is? The exit out of the 1987 crash. What the hell are they talking about? All these resulted in huge upside, right? Recovery from this, recovery from that, recovery from this. So whatever the hell they were making a point, it was useless, garbage content. And that was my beef with the tweet. And this guy won't let it go. He just keeps want to teach me how to do math. 10 minus 2. I realize what the hell it is. This is a visual representation of the moment it actually flips and then flip back. And look where it's at now. All right. Namaste. Zen. Anyway, this is the beef I go through when I hear these pundits, talking gibberish. Just use plain, simple English and stop pulling a fast one on us. We know what the fudge is going on. We're not idiots. Okay, so anyway, back to today's action. Stock market is really green with pockets of soft areas like banks. Not a time to get out of JP Morgan. If you didn't book up here like we did yesterday, this is not the time to start shorting it. It's a good bank. So in fact, it's the best bank. So what you do is you put a trigger to chase it. I should have put it up here actually. Okay, so I'll put 2 triggers. So how did we trade it? We went long down here somewhere with Wells Fargo. Up here it was like a 6 times win if you took a straight leg call, or if you took a spread, it was more than double. And I booked JP Morgan. I missed the exact top, so I left some money on the table. That's okay. I did the right thing. And as far as Wells Fargo, I booked enough to where I'm holding house money, and that's still a double. So I'll sit on it. I don't have any reason. Dips will be bought. There should be buyers into 91.5-ish. If they want to fill this gap, they'll be great. I'll reload long like I did before. So with the givens we have right now, the overall economy is not that great. In fact, it should be disastrous, but they might throw enough money at it to save it. Anyway, Nick signing out.